Welcome back to a special edition of Power and Politics from Toronto. The Bank of Canada is hiking its key lending rate once again in an attempt to cool inflation. That rate now sits at 1.5%. Here's how that could impact you. Say you have a loan of $100,000. That could be a variable rate mortgage or any type of loan really that adjusts its interest with the Bank of Canada's rate. During the pandemic, when interest rates were slashed to essentially zero, your annual interest payment on that loan would be $250. But with today's rate hike, your interest payment would jump to $1,500. That's 6 times higher than it would have been if the rate had stayed the same. To help break down the bank's decision even further, Jimmy Jean, chief economist at Desjardins, is with us from Montreal, and Peter Armstrong, CBC's senior business correspondent, is in Toronto. Hi to both of you. Thanks for making the time for this. Peter, let me start with you. What's the simplest way of breaking down the bank's decision today and the motivation for it?
Well, just think about it. Like every single time you fill up your car, every single time you go buy groceries, you know exactly how expensive life is getting, the pressure on the bank, and that the bank feels itself to do something to tame that inflation has clearly been well telegraphed, right? Like this came as a surprise to literally nobody who's been paying attention. We knew they were going to hike rates. We knew they were going to hike rates by 0.5%, which is a lot more than usual. And if you look at that long term, like the inflation has just been skyrocketing and going up and up and up. Well, rates were low. Now they're starting to catch up. But remember, I mean, the BMO forecast, I don't know what Jimmy shows, but the BMO forecast for inflation in May is that we're going to get to a 7-point-something% rate of inflation, which is just like, it's a staggering amount. So the bank has to do something. What it can do is raise those interest rates, try to get the parts of inflation that are under its purview, the domestic demand, housing, all that stuff, try to tame inflation on that side and hope we get a break on the international, the global stuff, food and oil, of course.
Jimmy, your thoughts on what Peter just brought up, and that is especially sort of the forecast. I thought some of the comments today were as interesting. I mean, the rate, as Peter points out, wasn't a surprise. The hike wasn't a surprise. But the comments about what's to come, especially that there are more rate hikes in the future because it doesn't look like inflation has peaked yet. What's your assessment of that?
Well, look, inflation has been unpredictable. And the bank's mandate is to keep inflation low, stable, and predictable. So right now we're in a situation where even if they upgrade their inflation forecast, which they have done in April, we keep seeing prints that are above those revised expectations. So it's certainly been very difficult to predict inflation, and in that context, their job is to really make sure that they raise interest rates enough to ultimately get that inflation back into control. So they've been pretty clear in their statement today that the risk of that inflation, that high inflation becoming more entrenched, have increased. And I think that's a very important message they're conveying. And they're also saying that they may have to be more forceful. So I think that those were very honest ways to put it to Canadians, in that even if we've seen some pain in terms of the pace of adjustment in interest rates, there might be more to come, just given how unpredictable that inflation has been.
Peter, help Canadians watching understand when we hear the terms, more entrenched inflation. What does that mean? Because I think for a lot of Canadians right now, when you hear inflation is rising, what you know it to be is that you go to the grocery store and things are way more expensive. You go to fill up your tank and things are way more expensive. If that is more entrenched, does that mean things are expensive for a lot longer than people had hoped?
Yeah, look, the concern here is that we can't sort of get prices under control, because there's two sides to it, right? Actually, you and I have talked about this a lot, that there's the domestic side of, like, domestic demand is still really hot. We saw that in the GDP numbers that came out yesterday. Housing prices are still up. Housing activity is cooling, but who knows what's going to happen with Canada's housing market. So what can we do on this side to try to tame those forces? And then there's the global forces at play, right? Like, your grocery bill is up because of climate-related activity around the world. Shipping costs are up around the world. Global oil prices are up around the world. That's causing the increase at the pumps. And there's not a whole lot Bank Canada can do to tame those. And so the entrenched part is just, as I say, the forecast is we're going to get into the 7% range of inflation for May, which is like, you feel it, you know it. You talk to somebody on the street today, you don't need to be an economist to know that prices are up. But 7%, it's such a big number. And the risks to the economy are so big that the bank feels it's got to do something now, because if it doesn't, that gets out of control. Then you get into threats of stagflation. You and I talked about that yesterday. There's a lot of risks at play here.
Jimmy, can you talk about your assessment of the general risk to the economy as you see it right now? And when you use the word forceful, when the bank uses the word forceful, but as you quoted in how it might tackle that, what translate that as well for our viewers?
Well, I think if you were to take any sort of theoretical framework to try to get a sense of where interest rates should be in order to tame inflation, it would tell us that interest rates should be at 8%. So that's pretty dramatic. And, today we're still at 1.5%. Now, having said that, theory is one thing, practice is another. And there are considerations why the Bank of Canada still needs to be careful, because we know, bringing rates to 8% in a heartbeat would precipitate a downturn here. We have a very sensitive economy, especially when it comes to the housing market and all spending that's attached to housing. So that's why the Bank of Canada still needs to go at it in measured steps. Having said that, we do expect inflation to hit 7%, above 7% in May. We still have an economy that's humming. We saw those numbers on domestic demand yesterday were very, very strong. And we expect to see part of that momentum being kept in the second quarter. I think in the third quarter, though, we're going to see more deceleration coming out, especially of the housing market, where we had a negative print for not just sales, but home prices in Ontario. And we certainly expect that trend to continue and to broaden out across the country. That's going to be instrumental in cooling down some parts of the domestic demand picture that Peter was talking about. And that ultimately is the channel through which monetary policy works to ultimately bring down that inflation. But certainly we're going to need a breakthrough on those ongoing supply chain issues or commodity price shocks. Otherwise, it's just is going to put even more pressure on the Bank of Canada to tighten even more. And that's when the risk of a hard landing comes into play.
Okay, I'm going to leave it there. Really appreciate you, both of you, helping us break this down. Jimmy Jean, chief economist and strategist with Desjardins, and Peter Armstrong, CBC's senior business correspondent. Thanks, both of you. Hi, I'm Vashi Capellos, host of Power in Politics. See more of our show by subscribing to the CBC News channel or click the link for another video.